My colleagues and I remain squarely focused on keeping consumers informed on the latest market moving information in efforts to help Americans borrow, buy, and build. Today marks meeting number 5 of 8 for 2024, and I'd like to take this opportunity to translate the latest Fed speak into mortgage English. As expected, the Fed left the benchmark rate unchanged for the 8th meeting in a row. Therefore, Fed funds remains at 5.25 to 5.5, effectively making prime rate 8.5% until the next scheduled FOMC announcement, 18 September. Despite leaving short-term rates unchanged, the Fed's benchmark rate does not directly control mortgage rates. Bond markets, mortgage-backed securities, inflation data, employment data, and investor appetite will interplay to change mortgage rates on a daily basis, leading to the fluctuations observed by borrowers and lenders alike. Since the last meeting 6 weeks ago, the 30-year fixed-rate mortgage has improved modestly, trading from a range high of 7.125 to a low of 6.75. Today, Jerome Powell again emphasized that now is not the time to lower rates, but have moved closer. There's been some further progress towards the committee 2% inflation objective, although remains somewhat elevated. In June, annual headline inflation dropped to 3%, while Q2 GDP improved to 2.8%, which is uncanny. Moderating inflation, reduced job openings, and slightly higher unemployment have moved risk on both sides into better balance. Recent data is encouraging, but rate cuts will arrive when supported by more data. Moreover, good data, not specific data points. Despite the wordsmithing, the mortgage market welcomed Jerome Powell's hints of closer as dovish, but did not materially impact mortgage rates. Recently, the 5.5% coupon crossed over the 200-day moving average, which is bullish for mortgage rates. The market will need time to digest the latest information and may not yet establish a trend for improving mortgage rates. Despite mortgage rates moving to a 4-month low, Triple B is more concerned with the behind-the-scenes activity, specifically the balance sheet drawdown and the prospect of eliminating quantitative tightening. The decision to hold rates today reflects the Fed's attempt to ride out the lingering impacts of the pandemic, leaving interest rates too low for too long. The suggestion that the Fed is closer but not yet committed to a cut in September is the very best thing to cutting rates without cutting them. The talk of cutting is not new information, but could be the reason for short-term optimism, which included more housing inventory and increased signed contracts for home sales in June, a broad-based improvement seen in all 4 major regions of the country. This is a great first step forward on the long-term problem of the lock-in effect. The fundamental demand that outstrips the supply will remain a long-term inflationary trend until there's significant improvement in long-term rates and more homes available to buy and sell. The Fed has 2 mandates, price stability and max employment. Housing is not one of them, and this problem is no more closer to being resolved. And now I take your questions. Let's start right side to the left, move this way. Go ahead.
Hey, Fed Chief, Regis Double. Berkshire Tribune, is the Fed risking a recession with not cutting rates this meeting? Savings are diminished, unemployment's higher, inflation's come way down. What are you guys looking for?
That's a great question. I don't feel that a 25 basis point cut is going to do very, very much. The Fed very much wants to return to a normal market, and who knows what that looks like either today or down the road. That may change. The man has said it, and let me repeat it. They're looking for more data, but the good kind. Now, when he says good data and not data points, he's referring to bad data. Just doesn't want to say it. Now, the prospect for cutting is getting closer next month, not because it's time, but between now and then, the Fed will get more data on unemployment and wage growth. And we'll, in fact, see by then if things are simmering or bad. The Fed has already acknowledged that the overheated labor market has cooled off, and that is a step in the right direction. It's a good news, bad news type of thing. If you think it's bad news for you, it's good news for the Fed. It gives them somewhat of a leash. Like they say, all good things do come to an end. And I think the Fed does have their eye on the ball when it comes to the unemployment rate. But big picture, it's been in the 4% range for 6 of the last 7 years, which really is a tremendous run. Hope that answers that. Next.
Earl Simmons, New York Rhymes. I'm worried that inflation is never going away. Housing's become so absurdly expensive. I don't know what that means anymore, let alone what it's going to mean for my children. Can you explain how the elevated cost of housing is related to price stability?
That's a very good point. In that game of expectation, you have to think that housing prices will ever return to pre-pandemic levels is highly unlikely. Based on the fundamentals we see in the market now, the demand outstrips the supply. Builders are still on their back foot from the last crisis. Uh, we're in a heavily regulated mortgage market. Now, there's still plentiful jobs out there right now, but there's way too many inflationary forces to fight. And although experts expect the pace of appreciation to slow and subside, it's a meatball's chance in hell that the home prices reverse course. Remember, the affordability is only half of the problem from the home price standpoint. A big issue is interest rates as well. Remember, if you bought a home back in January of 2020 based on the home prices and interest rates and compared it to the summer of last year, your home price increased 30%, but your mortgage payment almost doubled, which is why affordability, it's not all about home prices. It's just as much about interest rates. And again, this long-term problem for home ownership to become affordable again, we're going to need to get rates back to pandemic levels to take the edge off this market. Now, think of it. If the builders can't build many more homes and do it for a cheaper cost, property taxes, insurance, they're not getting any cheaper. But the rates we can manufacture. The Fed can cut rates by not cutting rates, as indicative of today's meeting. So I think it's very possible and likely that the mortgages will return to the land of 3% over time. May not be very quickly, but we will get there.
Hi,
Go ahead.
Patsy. Better Loans and Garden. All this word salad's making me hungry. Transitory, higher for longer, data dependent, and now closer? What gives you confidence they have it right this time?
Well, we should all understand that the current monetary policy is a reaction to the lower for too long. The Fed admits that they didn't know what they were up against during the pandemic and left rates low as a lesser risk than moving them higher with the amount of uncertainty in the market. Monetary policy is only one of the tools that are in the box, and it's not the sharpest tool in the shed. There's way too much emphasis on monetary policy today because the Fed has other tools: forward guidance, open market operations, quantitative tightening, and quantitative easing. Some of it you see and some of it you don't. Great pickup on the closer line. Time to put that in your repertoire. Hey, you back there, coffee, it's for closers, okay? Not closers, closers. Sorry about that. I take the word closer as a synthetic rate cut in itself. If you looked at the stock market today, you might want to wait to give that some more time to digest the word closer and how they want to interpret that. But if the Fed is getting the market to do what it wants to do without them doing it, they won. When he says data dependent, and you ask, well, what does that mean? He doesn't answer with what it is. He tells you with what it is not. I.e. data point dependent. Get it?
Oh, hi, Matty. Jim Harbaugh, the Delco docket. The Mortgage Bankers Association says that the MCI, a measure of mortgage loan application volumes, decreased 4% for purchases, while the refinance dropped 7%. Will rate cuts stalling eventually stall the housing market?
Great question, Jim. I think you've brought up a really good point. Fed cut optimism is the modern day BDE. It's going to get you interested, but ultimately short lived. There's going to be a lot of pain at the closing table for years based on these prices and rates even in the 5 to 6% range. They say the magic mortgage number is any rate with a 5 handle. Personally, I don't find anything magical about 5% as your payment per 100,000. Even at 5% is well over $530 per month. Think if you have to put down 10% on a $450,000 home, you're still looking at a principal and interest payment over $2,000 per month, and that's without the taxes, the insurance, dues, maintenance, etc., everything that goes into just the monthly cost. It's still a very expensive proposition. And there's a great study done over 30 years of data. And I just want to let you know that home prices go up when rates go down, and home prices go up when rates go up. So historically, it's a lose-lose situation on home prices. And I don't see that ever really getting any easier now or in the future. Next.
Hey, Chief Dave Pucci, Mortgage.com. Fed speaks about moving back to neutral rates. What is that exactly? Is there a neutral rate for a mortgage?
Honestly, I don't think that the Fed even knows what neutral means anymore. Jerome Powell said it earlier this year. I guess that number moves all the time, and they can't see it in real time. Neutral means that it doesn't restrict or encourage spending. Now, other Fed chairs have said the number may be based on inflation. The old world, they used to refer the neutral number at 4.5%, but within the last handful of years, moved that down. Some have mentioned even 2.5%. At the end of last year, they mentioned by 2026 they could get inflation down to 2% with a benchmark rate of 2.6. I don't know what that means or how that translates into the world of mortgage. It's equally challenging, but I remember if we use the great financial crisis as an example, anything with a 5 handle did bring people out of the woodwork. But relatively speaking, since the pandemic and being spoiled by those super low rates, the lock-in effect is real. Remember, home equity lines of credit are based off of prime, and prime is 3% over Fed funds, and then you have to add the bank's fee on top of that. So effectively, you're borrowing at maybe 9 or 9.5%, which is really restrictive and expensive right now. And consumers will tell you that it's too much of a risk to part ways with their 3% loan. So having to borrow at 9% is going to make people really think long and hard if they need to borrow right now. Most of the borrowing that we see in this market is done out of necessity or simply because you can. They're both extreme ends of the spectrum, but hardly any middle players in this market. Now, they say that 60% of the outstanding mortgages have a rate less than 4%, and 1/3 of the outstanding mortgages have a rate below 3%. Right now, based on the average price of a home, I think 4.75 is the closest that you could probably get to a neutral rate in the world of mortgages, but we'll have to wait and see.
Hey, Chief Manning, do you believe in rate cuts before marriage?
Well, that's a good one. I don't, but you guys know that already, right? I say it like this. You without me is like Hal Melvin without the Blue Notes. You'll never go platinum. Okay, I think we've got time for just one last really good question. Honest question. Over there.
Yeah, Paul Lynch, World News. Nice specs. I think you need to enter those into the Glasses Olympics, don't you think? Now, here's my question. We saw bankers all over the world move in different directions for their short-term rates this month. It was surprising to see the European Central Bank hold, Canada cut, and the Bank of Japan raise rates. Tell me, what's going on?
Well, July has been an exciting month, and it's quite shocking to see how all of this has unfolded. But we're seeing, no pun intended, different levels of weakness in different parts of the world. You forgot to mention China because the bankers in Beijing cut rates across the board last week. Who would ever predicted that they've never even raised their rates or essentially ever stopped cutting them based on their last move? And if we just compare, the pandemic with the great financial crisis, Yeah, China's economy way back at the GFC was so strong. Who would have ever imagined that they'd need QE? That just seemed utter out of this world and experimental with America trying that, but it is apparent it's become a global phenomenon. So I don't know if that's a good question for me, as I don't have the answer. Every day I wake up and I think I'm in a clown world because nothing surprises me anymore. Bitcoin, 100,000, 200,000, sure. Japan raising rates. They have serious problems over there because QE does not have any effect anymore. And when you overuse something, it loses its effectiveness, and over time, you have to do something more and more extreme. Is QE really all that innovative when countries like China are into it now? It's like that vapor song, "Turning Japanese." I think we're all headed down that way in many respects, and I think it's only a matter of time before the U.S. crosses into the negative rate territory. They've spoken about it, and what do we learn today? That they're getting closer. What are we closer to? The end? I'm not sure. Okay, well, that's easy come, easy go. No brass, no ammo, Sarge. See you all on the next one, unless you can catch up with me Creekside at Jackson Hole. Until then, Maddie's got your back. So see you guys then.